What's up, guys? Welcome to Stock Talk with Nico Kritikos. Sorry I have not done a video in a very long time. I had lots of people asking me what was I doing and how come I wasn't making stock videos. And the reason is because I've been working on a business, which I will show you here in a minute. But the point of today's video is going to be going over the trade desk because I did sell my shares today, which I didn't make a giant position in this, but it was a stock that I did own. And the main reason I wanted to get rid of it was just because I think number one, I'm not a fan of holding stocks that have high valuations, which this one definitely does. And especially in this sort of tumultuous, volatile times that we're in, where, when stocks are crashing, you really don't want to be holding a high valuation stock. So we're going to go down here. Luckily, so today I was watching this and my shares executed at $72 a share, I believe. So it went up a little bit more, went to 75, so I could have made a little bit more money, but it ended up at 70 for the day. So I think I pretty much broke even on my shares, which was fine because for a while there, these stocks went all the way down to, 45 bucks a share, and it was pretty scary because this stock was just incredibly overvalued. I mean, if we look at the PE ratio history here, we can see that although the last couple of years this stock has traded very rich for, a long time, like 150 all the way up to 400, like is pretty much the normal for this. And you can see, so we were at 400 here in 2022, and we've been falling since then, right? And, you could look at that as a bullish thing and say, okay, well, now the stock is finally cheap, but it's really not. I mean, it's trading at 91 times trailing earnings. That's not cheap by any metric. It's not cheap. And then you go look at what the company's growing at. Okay, they're doing 17% growth and 18% growth in revenue. It's nothing that great. So to me, it definitely is not justified to be trading at 90 times earnings. So that's why I was happy to sell the stock today. I got my money back, and I think there's better places to put your money. But the reason the stock went up is because investors obviously they beat on earnings for one. If we come down here, we can see they did 33 cents of EPS instead of 25 that was expected, and then revenue of a little over 600 million when 575 was expected. So shares were up 22% today, huge jump. And so, I mean, that was the first piece. And then the second piece here was that it looks like they bought this new company, Kokai. Kokai, I don't know how to say that, but it's a AI platform. And it looks like that was actually helping them this past quarter. So we have that, and then we have a bunch of analysts raising their price target to $80, which is just crazy to think about because this stock is, I mean, they're going to do under $2 of EPS. And so that would be, I mean, again, it's just I don't know. You're talking about what over 40 times, 50 times earnings on a forward basis. That's just crazy. It's not something I want to own because I feel like it's too much risk. So that's why I sold it. And it says there's competition from Amazon. Company second quarter guidance for 17% revenue growth is encouraging, especially considering it accounts for weakness in certain brand budgets like automotive and consumer packaged goods, which is fine. And then another analyst raised their price target to 80 bucks. So again, I mean, you look at the last couple of years, this stock has traded very high. I mean, look at where it was, 6 months ago when the stock was $140. And then I remember when it had this huge crash, and I remember just thinking like it could keep going a lot more because when you're trading at, 200 times earnings, who's to say you can't go back down to, I mean, a reasonable valuation would be like 25 times, 30 times earnings, something like that, right? If not cheaper. I mean, really, you can go to 15 or 20 times earnings. So that's the range I feel comfortable investing in is when you're in that range of like 15 to 30, right? That's when it's good. If you're investing in the range of like 30 to 60, that's where it's riskier. You got to be really careful because there's a very small percentage of stocks that are able to consistently trade at those valuations, right? Amazon did it for a little bit, Tesla did it for a little bit. Tesla even came down to, 34 at one point. So, and Amazon, I think that PE is starting to condense a little bit too. I don't think you're going to see 60 times earnings for Amazon forever. So that's just the way I look at it. As far as the numbers go, I mean, I love the business model. The numbers are great. You look at the revenue here, right? It's as consistent as you can get. The numbers are all going in the right direction. They did what, close to Oh, so they haven't factored in Q1's not registered in this chart yet, but they beat EPS. I mean, the numbers are fine. The numbers are good. The balance sheet is strong. $2 billion of cash, no debt. Everything looks good to me. I do not feel comfortable really holding those. So this is saying it's trading at 40 times the next year's earnings, right? So still, that's just tough for me. I mean, this is not some insanely fast-growing company. They're only growing at 17% per year, and I would think that would probably slow. I mean, maybe they keep up around that maybe 15 to 20% for the next 5 years or something. But again, that's not enough to justify that sort of premium for me. So that is my take on. Oh, let me show you my business, what I've been working on. So the business is AmericanTallowStore.com. This is my store. It is a beef tallow company, and we are selling jars of tallow for $16. It is used for cooking, it's used for skincare, it's used to make soap. You can make candles with it. You can do a bunch of different stuff. And then we got some t-shirts coming out too. But this is our first week in business. We just opened it up. It's all USDA approved from, farms and facilities. It's 100% safe, 100% healthy. The main thing is just to get an alternative to seed oils because seed oils don't do well under when you cook with them at high temperatures. They break down and they, release free radicals. It's not good for your health. And so that is why we are getting into the tallow business because we think there's a bright future ahead. So that is all that. But anyways, that is my take for Trade Desk. Let me know what you think down below, and I will see you in the next video.